All right, future CPAs, let's be real. Home office and branch accounting can be a total nightmare. I mean, we've all been there, staring at a reconciliation problem, wondering why on earth the numbers just won't line up. But what if I told you there's one simple hack that makes this whole topic just click? Today, we're going to break it down, not just for your next quiz, but for the long haul, all the way to the board exams. So let's just get right into it. The number one reason for all the confusion comes down to these two accounts: investment in branch on the home office's side and home office current on the branch's side. In a perfect world, they're supposed to be balanced. But with all the transactions flying back and forth, they get out of sync so easily, and that's when the exam panic really starts to kick in.
But here is the secret sauce. Seriously, forget trying to memorize a dozen different journal entries for every little thing. You only need one single core concept. I call it the reciprocity mirror. And trust me, once you see it, you will never be able to unsee it. It changes everything.
Okay, let's lock this concept in. The reciprocity mirror isn't just some cute name for a trick. It is the absolute fundamental logic behind all of this. If you can master this one idea, you've pretty much mastered every journal entry they can throw at you. First, let's get the boring textbook definition out of the way. These are called reciprocal accounts. Basically, the home office uses its account to track its investment in the branch, and the branch uses its account to track the equity it has from the home office. But the only part you really need to burn into your brain is this: equal but opposite balances. Think of it like a perfectly balanced seesaw. And right here, this is the mirror in action. On the home office books, the investment in branch account is an asset, so naturally it has a normal debit balance. Now look in the mirror. On the branch's books, the home office current account is basically equity, so it has a normal credit balance. They are perfect, opposite reflections. Whatever happens to one side has to be mirrored on the other. All right, theory is cool and all, but let's see this thing work in the real world. We're going to walk through the 4 most common transactions you will absolutely see on the LECPA. We'll journal them side by side so you can watch the mirror do its magic. First up, the most basic one you can get. The home office sends some cash, let's say 3,000 pesos, to get the branch up and running. Just look at that perfect symmetry. On the home office side, we debit investment in branch to show, hey, our investment just got bigger. The mirror immediately reflects that on the branch side with a credit to home office current, showing its capital from the home office grew. See, a debit on one side is perfectly balanced by a credit on the other. Simple. Okay, let's keep the ball rolling. Transaction number 2. The home office ships out 6,000 pesos worth of merchandise to the branch. And are you seeing the pattern yet? It's the exact same logic. The home office's investment went up, so they debit investment in branch. On the other side, the branch's equity from the home office went up, so they credit home office current. The reciprocity mirror holds up perfectly. The logic never changes. All right, now for a curveball. This is where people sometimes get tripped up. The branch goes out and buys a fixed asset for 2,500 pesos, but the company policy is that the home office keeps all the fixed asset records and pays the bill directly. So how does our mirror handle this? Okay, let's break this down. Don't let the extra entry on the home office side fool you. First, the home office just records the purchase itself. That's the debit to branch fixed asset and credit to cash. But then it makes the entry that matters for our mirror. It increases its investment in the branch. That's the debit to investment in branch. The branch's side is way simpler. It just records the asset it received and credits home office current. So at the end of the day, the investment account and the current account are still in perfect balance. And here's our final core transaction: expense allocation. The home office covered some general expenses like admin costs, and now it's charging 1,250 pesos of that to the branch. This usually comes in the form of a debit memo. And again, the logic is absolutely flawless. From the home office's perspective, paying this expense for the branch is just another form of investment, so it debits investment in branch. Over on the branch side, they record the expense and they acknowledge that they now owe the home office for it by crediting home office current. So you've seen the core 4. Now let's shift into exam mode. We're going to put the reciprocity mirror to the test with some rapid-fire theory questions, just like the ones you're going to see on the actual test. This is how we make the rules stick. Okay, first question. Your branch gets a debit memo from the home office. What does that do to your home office current account? Think about the mirror rule for a second before you answer.
The answer is it will increase the balance. Here's the key takeaway. A debit memo literally just means the sender debited something on their side. So the home office debited its investment account, increasing it. The mirror rule says the branch must do the opposite, credit its home office current account, which, because it's an equity account, also increases its balance. Let's flip it around. Now, the home office receives a credit memo from the branch. What's going to happen to the investment in branch account balance? Go ahead, pause, and work it out using the mirror rule. It's going to decrease. And here's why. A credit memo from the branch means the branch did something to reduce what it owes the home office, like returning extra merchandise. On their books, they would debit home office current to lower that balance. And what does the mirror demand? The home office has to do the opposite, a credit to investment in branch, which decreases its normal debit balance. Okay, we've gone through the theory, we've gone through the practice. Now we've arrived at the most important part of this whole explainer. This right here is the slide you're going to want to screenshot, memorize, and look at right before you walk into that exam room. This is your ultimate cheat sheet. This table is everything. This is your key. Go ahead and screenshot this right now. But notice the beautiful, simple pattern. An increase for the home office is always a debit, which is mirrored by an increase for the branch, a credit. A decrease for the home office is a credit, mirrored by a decrease for the branch, a debit. This table isn't about memorizing. It's about seeing the reciprocity mirror in one clean summary. And there you have it, the one concept to rule them all. No more getting lost in the weeds, no more second-guessing your journal entries. You have the tool, you've seen how it works, and you have the cheat sheet. You are absolutely ready to go out there and crush this section. Good luck.